In the last couple of chapters, we have studied how introduction of volumes will add a completely new dimension to your trading. We also studied the key guidelines that you need to consider when correctly implementing volumes in your trading. In this lecture, I want to move to the next level and combine the various price action patterns with volume. In a manipulated market such as Forex, volumes reveal the truth behind the price action. You will learn how the price action on these patterns is validated by volumes, hence providing an even stronger confirmation of a reversal to a retail trader. Before moving forward, let's understand some basic principles which we need to keep in mind while combining volumes with price candles on a candlestick chart. Please go through these three key principles. So guys, in the remaining chapter, I have used examples to explain how volume validates the signal top, bullish engulfing, double bears, the hammer, and long-legged doji. Similar principle applies to other price action patterns as well, which are not included here in the examples. In this first example, we are looking at a signal top formation which indicates buying weakness after an uptrend. In order to validate the signal top, let's study the complete uptrend. In the initial phase of the uptrend, notice how the price is trending higher with wider real body bullish candles. Now this initial price is confirming that professional traders are pushing prices higher, hence validating this price move. Now in the second phase of this advance, notice how the volumes increase near the price top. However, these candles have narrower real bodies. This price action reflects anomaly and hence giving us first warning that a trend reversal is due. And finally, a signal top appears with highest volume in recent price action, confirming that a new downtrend has begun. Following the signal top formation, price enters a congestion zone for next few candles before the downtrend continues. The second example is of bullish engulfing pattern, which is indicative of buying strength after a clear downtrend. Since a bullish engulfing pattern is a two-candle formation, therefore in order to validate the price action, both candles must have increase in volume. After a clear downtrend, a bullish engulfing pattern appears where the volume of engulfing candle is clearly higher than the volume of first candle in the formation. The same rule applies to a bearish engulfing pattern too, as increasing volume over the two candles validates the bullish and bearish engulfing price action. The third example is of double bears price action formation, which reflects the selling strength returning in the markets after an uptrend. As you can see here, the volume on each candle falls as market nears a price high. Notice how shooting star candle comes as a first sign of warning. It is our first clue as retail traders that a market top is near. However, we wait for further confirmation as the shooting star is accompanied by low volume bar. And the trend reversal confirmation arrives through the double bears formation, which is accompanied by increase in volumes. Hence, volumes validate the double bears price action on this chart. The next price action we are looking at is the hammer candle formation. It is a classic candle of buying strength returning in the markets after a clear downtrend. Hammer is seen when in a session the price has fallen only to reverse to close near the opening price. We studied earlier that larger the lower shadow, stronger this price action. And when combined with high volume, hammer becomes even stronger. If you notice here, a candle prior to hammer was a narrow candle but accompanied with significantly higher volume. And when hammer appears, the volume bars rises even higher, validating the reversal. The fact that the hammer appeared after the congestion or consolidation phase gives more strength to this price action pattern in this example. The final price action that we are studying in this lecture is doji, but not just any doji, it is the long-legged doji. A long-legged doji signifies indecision as market reaches a point when bullish and bearish sentiment is equally balanced. On this chart of euro and pound, a long-legged doji follows a strong bullish candle. However, what makes this pattern immensely powerful is the increased volume on long-legged doji. This increasing volume sequence is the price validation that a retail trader must capitalize on. Guys, this also concludes the final lecture on volumes. Please practice all the guidelines we have studied in this section. You will find multiple examples of what we have studied here on different forex charts. Now that we have studied how Elliott wave analysis, price action and volumes validate each other, it is now time to study the complete forex trading plan in the next section of the course.